Hi, Ross McInnes from Australian Investment Research Services. It's Sydney 12:30 p.m. time. Just to give our view of the March quarter GDP numbers which were just released in Australia. Basically, they showed a fairly modest growth rate during the first quarter of 2010 for the Australian economy of 0.5%, annual growth rate at 2.7%. The numbers were supported by an 11.3% increase in government capex, which was in the numbers yesterday, the government finance numbers that came out yesterday morning. The private capital expenditure numbers were actually quite disappointing, especially on the equipment side, which fell 5.7%. Other aspects of the numbers though were reasonably okay. Private consumption or household consumption was up 0.5%, which is pretty good, around trend levels. The government also contributed this 0.8%. Net exports reduced GDP by 0.5%. And inventories contributed 0.2%. So the overall feel of the numbers was that, again, government support and stimulus has provided a much needed uplift for the growth rate, and it's keeping the economy on the forward, moving forward. The focus now for the June quarter is obviously on that recovery in private business spending. One constraint here will be the resources tax, which has created a bit of a conundrum over the last couple of months, whether the resource companies really do cut back on projects and anticipated projects, which may flow on into the GDP numbers. But also the fact that the RBA is on hold now, probably for another couple of months, is probably going to help private consumption. So these balancing out factors. There are also some pretty pleasing aspects to the March quarter GDP numbers, which we'll talk about just now. The terms of trade, as per the RBA policy and Treasury policy outlook, was strong at plus 4.2%, following a 3.8% rise in the December quarter. What this means is that national incomes got a good support through the March quarter and are up 1.7%. The other positive was the fact that employment increased 1.1% through the March quarter, and this seems to be an ongoing factor in the Australian economy looking forward. The unit labour cost numbers and also the wages cost as a factor of profits continues to fall, and quite heavily actually in the March quarter. So there's definitely, labour is definitely cheap relative to profits at this point, and that's likely to be a strong driver, as it was in 2008 when we had similar relationships occurring. So the overall Australian economy doing okay, but dependent at this point still on government infrastructure spending, which has been on schools, housing, and also broader roads activity, which was also part of the budget. And we really need to see the private business spending to pick up in the next couple of months to offset the fact that the government is starting to wane. In terms of markets, it's helped the Australian dollar stabilise and grind a little bit higher after last night's volatility between 84.40 and 82.80. Aussie at presently 83.75. Still watchful of the euro, which hit 4-year lows yesterday at 121.10 and currently trading 122.55. Overall, we still believe medium term that there are buying opportunities, but the volatility is unlikely to have stopped at this point. And waiting on those US payroll numbers on Friday night. So we'll speak later tonight to update you on how the European markets are going.